Hello and welcome back to Dukascopy TV. Today I'm joined in the studio by Michael Hart to discuss the strengths and weaknesses of the US dollar. Welcome, Michael.
Thanks for having me.
All right, so first of all, how is the US dollar performing right now?
Well, it's actually interesting. There's some interesting developments. We had, of course, quite a run-up in the dollar in terms of the broader index, the DXY. We've gone all the way up to 83, which is not very far from the crisis highs at 89, but the DXY, of course, is composed to 60% of euro-dollar. So euro-dollar has had, quite a strong development in one direction in favor of the dollar. But if you look at the other crosses, dollar versus Latin America, dollar versus Asia, it has actually weakened quite a bit over the last month or so. So there's quite a discrepancy depending on which cross you look at.
And in your opinion, Michael, what are the strengths and the weaknesses of the US dollar?
Well, the dollar generally benefits from the economic outperformance. As lackluster as it may be at the moment, it's still stronger than in other G10 economies and the Eurozone in particular. So that's a factor supporting the dollar. Another one, of course, is the fact that it does continue to act as a safe haven in times of increased risk aversion. It's highly liquid. It's a reserve currency. So there's always a lot of demand for the dollar. Of course, there's also a flip side to that, in that it is collateral to developments in other asset markets, in commodities in particular.
And what is the political situation like in the US at the moment, and how is this affecting the dollar?
Well, it's obviously a very complex situation, but I think what matters for currencies the most is the imminence of the so-called fiscal cliff, namely a fiscal contraction that's looming in the US worth some 4% of GDP. So really, what will be critical is how negotiations in the House, in the Senate, revolve around that. It's likely that there will be some agreement that will take back some of that fiscal tightening to perhaps only a 1% of GDP contraction. But that's something that will be a nagging factor, nibbling away at the strength of the dollar at times.
There's a negative correlation between gold and the US dollar. Gold, which is usually seen as a safe haven, at the moment it's not, and people are putting their money into the US dollar. What are your views on this?
Yes, that correlation is usually what is the case, and it's one that makes perfect sense based on the laws of supply and demand. Gold is a safe haven to an extent. People like to invest in it as a store of value in times of high crisis. Of course, the increase in the price of gold has already been phenomenal, and we're now entering sometimes periods where we get positive correlation between the value and the value of gold. And those are times, actually, when we see that correlation moving towards or into positive territory, those are times when risk aversion is increasing, sentiment is deteriorating, and then you see that percolating into other currency areas. For example, a sell-off in risky currencies like the Aussie, like the CAD, or some of the emerging markets. So that's an important correlation to keep track of.
And with the situation in the Eurozone at the moment, what are your views on the euro-dollar?
The euro, of course, is a very intriguing currency because it's been fairly resilient throughout the last 2 years when the Eurozone crisis kept deepening and deteriorating. At the moment, currency markets really have backed away from pricing in tail risk, and in particular the option markets have. The risk reversals have traced back quite substantially. Implied volatility has dropped significantly. And we're also seeing, in fact, that the long end German yields are going up. So that's telling us that markets are not believing in a breakup of the euro and the Eurozone, but they think eventually there will be the fiscal transfers forthcoming from Germany, and that by hook or crook, we're slowly evolving into a fiscal union for the Eurozone. Now that's a fairly benign view from my standpoint. I don't think we will actually get there, and certainly not as quick and in as smooth a fashion as markets seem to be pricing in. So I still see a very volatile time ahead for the euro, and I see it weakening substantially as well. The question is, of course, during this period of volatility and choppiness, how will policymakers respond? Because both in the US and in the Eurozone, there are various policy tools that decision makers have at their disposals and that they will resort to. So it's very much a question in particular as to when the Fed will be resorting to the next round of QE, of quantitative easing if they will, and when the ECB will respond with its own toolkit.
And finally, Michael, what's your prediction for this pair for the next 3 months and the next 6 months?
Well, I think the Fed is certainly going to be more proactive in responding to these crisis moments that I just mentioned than the ECB. So I think QE3 perhaps in a different guise than previously. I think the Fed is taking some inspiration, some cue from what the Bank of England has done in particular. But the point is that they will do it earlier, I think, than the ECB. And so you could get an initial phase where you see a little bit of dollar weakening, which could prop euro dollar up into the mid 120s, 125 or above. But then as the ECB is forced to react really and expand its balance sheet again, perhaps undertake further measures in terms of lowering interest rates, not just on the deposit side, but also for current accounts, then that is something that would chip away at the value of the euro. And I think at that point, sort of into the 6-month horizon, we're going to start retesting the previous lows, first going through the 120 barrier, and then the crisis low of 118.76. That's certainly the next milestone to watch out for.
Michael, thank you very much for sharing your views on the US dollar today.
Pleasure, nice being here.
Thank you for watching Dukascopy TV. Stay tuned for more exclusive interviews like this one, but for now, goodbye.